pullback should be into some kind of logical area. And as you can see here, the resistance area, supply area here, we have new high breakout here. You have here two logical support points. And you have the 10-day moving average, and you have that price volume area here. And I will be kind of buying as it crosses this kind of upper wick of the day before, putting myself in a very favorable situation in terms of the risk multiples. So you always have to keep in mind that the first few natural reactions are addable. So you can be easily looking into the add spots. As we said here, it's respecting the 10-day moving average. If it bounces here from a 10-day again, very easily addable. As you can see here in this breakout, volume coming in, sign of strength, you can be buying, adding back. I might try to front run the breakout sometimes. Also the reason there is to again minimize the stop, so I might be trying to get a little bit lower with the thing that okay, there are increased odds I'll get stopped out, but at least that stop will be lower. Whereas we'll be looking into break of the downtrend itself. I'm not gonna be trying to fish the lows. What I want to see in the base would be at least the break of the horizontal line here. It formed another very nice, you can call it a pullback buy, or again the low cheat with actually more defined pivot. When it crosses this high, I would be starting to buy again. And logically again, started correcting there. For me, that's why I moved the stop up and place it into an area, since we would expect, if you have another pivot setting up, then you would be expecting some action, kind of staying inside and forming it, basically turning that prior resistance to support level. What I did here, started with a very tight stop, with a 2% stop only. If you have such a tight stops, you can try multiple times, because then if you get 3, 4, 5 multiple risk ratios and next tries, then it's gonna all pay off.
All right, welcome back, everybody. The next presenter of the TraderLion conference is Leos Mikulka, top performer of the U.S. Investing Championship last year with a return of over 400%. Today, he'll be focusing on a really important part of trading, position management, sell rules, selling into strength, how to manage your positions and manage winners, because we all actually know, winners don't just take care of themselves, so we have to approach them properly, and he'll be sharing his process for that, along with a bunch of other great tidbits about achieving strong performance. So Leos, thank you so much for being here. Looking forward to this, and yeah, thanks so much for your time.
Yeah, thank you for having me, and also thank you again for putting this trading conference together. I think when we see the names that are presenting, I think it's an honor to be here, as a privilege. So I'm very grateful I can put a little bit of what I'm doing, and hopefully it will be useful at least for somebody. What I would like to go through is, as the headline says here, managing trades with price progression in mind. What it actually means is, because of course everybody wants to catch a big winner, and what I will touch in one of the slides is a lot of people start with a can slim or traditional growth investing, and very often you just see buy points and trying to add to the position and ride it all the way. But very often this is not the case. Very often there are points where you have to trade around the position, you have to reduce into strength, sell, you're gonna get stopped, knocked out, how to get back in, and so on and so forth. Just very quickly, some intro about myself. I've been trading now nearly 10 years. Personally, I'm not a full-time trader or professional trader, even though with my time zone being in Czech Republic, you can kind of understand it as a second, being basically full-time trader with a second job. Otherwise, I'm working in a software industry, and I'm coming from a sports background. That's also maybe where the competitiveness comes from, and the kind of being the last in line, having the responsibility, for making any mistake, and bringing this into the trading perspective. And also recently, not to have enough time, I also became a new father. So
congrats.
Thank you. So another thing to take care of and take care of the risk management from that sense. Otherwise, from the trading perspective, as you can see here, I would classify myself as a swing trader. As you will see on the further slides, my average holding period will be anywhere between roughly 10 to 20, 30 days. Approximately, of course, it's an average, so I might be kicking out some winners very early. I may be trying to ride some big winners through market leaders a little bit longer. But otherwise, my average stats from a long-term perspective, as you can see here, are The average gain is somewhere, and depending on the market conditions, anywhere about roughly 6 to 12%, with average loss 3 to 6, trying to maintain at least that 2 to 2.5, 3 to 1 R ratio with a batting average approximately about 50%. Sometimes it's closer to 40, sometimes closer to 60, again depending on the market conditions. And what I would say, I guess the big things from what I'm doing is I'll be very quick to reduce into strength. I'll be having a tight stops, which I'll be quickly moving stops, and of course occasionally I'll be catching some of these small gains, occasionally catch a big winner. Of course it has some drawbacks. Very often I might get stuck in a losing streak of maybe 20 losing streaks by using these tight stops. But on the other hand, when conditions are great, like in last couple of months, you might be catching on the other hand 20 big winners with basically free lunch. When I go to a basic how I started with the trading, as I said, as many of us started with William O'Neill and the IBD Investors Business Daily, and with this book How to Make Money in Stocks. And the very funny thing with that book is, like, every time you come back to it, you will discover something new. So when you read it first time, you probably see, like, okay, there are some bases, there are some cup with handles, and on the way back I have to be adding it to my position to ride the whole trend for maybe 1.5, 2+ years. Like example with Coca-Cola, with these timeless principles, it appears over and again. And over time, however, we will probably start thinking, what does it mean when the William O'Neill says 20% is profit taking zone? What does he do? Where does he take profits? Of course, I cannot see into his mind, but I try to highlight here probably what I would do, what I would try to do. As you can see, it's kind of a dancing around with that position. So when you start buying from the first base, you probably want to hold a little bit longer as you progress through the base. You might be holding into that first high handle or natural reaction, but over time you might be start reducing and freeing that capital, because of course time is also money, so you want to have capital available on hands maybe for some next breakout which is lined up and is going through the buy points. So there's multiple ways how to handle it. We will touch on multiple of those aspects in the further slides, but I just wanted to highlight that key principle of probably what I would be doing. I will very rarely catch the whole trend. I will most likely be several times out, and then I might have, depending on the strength, I might have to be getting creative of trying to get back in. But yeah, and then as you can see, during that trend, I will be probably trading the position multiple times. Further influences, as I said, I started with the canceling, but who further defined kind of my style, I think one of the key foundations, or the very solid foundations, were when I joined Mark Minervini services, and was kind of inspired by his books, by what he's doing. And I guess the main thing which kind of stuck in my head, and the principles that I put into my trading, are his quotes: improving your worst case scenario. Immediately when you get into a trade, you want to be moving stops, de-risking. For example, if you start with the average stop of 5%, you want to get ASAP into 4, 3, 2%, maybe to break even and kind of free roll the trade. It's another of his term. You guarantee some profits. Now if you get stopped, it's going to be the worst break even. And further on, I got along with Leos Mikulka, who kind of helped me to fine-tune this strategy and start looking to also alternative strategies, like looking lower into bases, kind of understanding the whole price progression, supply and demand action. And one of my favorite quotes that I picked up is 100% cashometer. It kind of goes along with getting ready lower in the base. When everybody's going into cash, you have to start going through watch lists and really trying to identify the next true market leader, and maybe potentially start getting on already a little bit earlier than from a classical cup with handle or similar patterns. So also if you want to get little bit of what we're doing in the champion team trading, feel free to join. I think we'll be very happy to have you on there.
And Leos, before you go to the next slide, so sorry.
Yes.
Could you just expand a little bit on what free rolling means? Because I know you explained it quickly, but some folks watching might not be super aware of that term, and you'll be showing examples of it for sure. But could you just give another quick definition?
It's very, very simple, actually. It's basically taking the profits, the amount of profits, or moving the stop to the scenario when if you will get stopped out, you will not lose any money. So for example, if you say your initial stop is 5%, if the stock moves up 5% and you say half, now you get stopped for 5%, you're at break even, right? Or there are various strategies where you can combine, we will talk about it, where you can combine actually raising the stops maybe to 2.5% and taking off a little less, or maybe moving the stop to break even and higher.
Yeah, perfect. And this helps your mindset as well, not just the capital sense of it. Yep.
Other thing I wanted to talk about is, because maybe throughout the slides very often you will hear term overhead supply, or a lot of people might hear it when you listen to several talks, and there's always this term mentioned. I think the key principle is to understand what supply and demand is. If you think about it, the supply, it comes from a Latin supplere, means fill up. So what it actually means, right? When we say there is a supply, it means there's somebody trying to fill up the market, trying to give you the goods, and are happy to dump it in certain prices. On the other hand, demands coming from Latin demandere, ask for, is people calling for something, right? People are willing to pay higher prices. People are calling for, expressing their interest for certain goods. So if you have a lot of supply, it means there's the market is overflowing with goods, but you don't have any demand. It's naturally causing the prices to drop, right? Because the sellers need to get rid of their goods. On the other hand, if there is a more demand than supply, it means the buyers are willing to pay higher prices, and there is basically no sellers left. And what I just wanted to highlight, if I would show you these slides and not telling you what kind of name it is, not giving you moving averages, and if you just look at it first, like, what do you think? Where is the supply? Where are the trapped buyers? Where are the sellers? Right? It's some people might say, okay, I would like to fish along the lows because it looks super cheap. On the other hand, some more experienced people might say, okay, there are no buyers. There are no sellers there anymore. Here, the buyers are probably willing to pay higher prices if it moves through. Right? Both scenarios for certain styles are, I guess, feasible. You just need to know your style, and I guess what's the most important is there is the highest probability that you will experience less fluctuations, less volatility, the scenario where there will be less sellers on the way up. And if we move next, just to give you a heads up what it is, if I give you moving averages, you probably have a clear example where you would be buying, because suddenly you see 200-day moving up, 200-day moving average moving up, 200-day facing down. You probably don't want to be entering in this kind of a messy scenario with vigorous ups and downs. And as you can see here, if you would be trying to get on board at this point, what happens after? You immediately hit probably that supply that we are talking about right here. It causes the prices to drop. There is really no demand in the market. Same thing happens here. You again run into those sellers right here, and eventually once you drain all that supply, you will finally start moving up. On the other hand, if you would be buying in this area where there's basically nobody up here, then you have kind of a smooth sailing up. And maybe if you would start before starting looking at daily, if you would actually start looking at weekly, it will probably provide you even clearer example, because immediately you can see kind of transitioning from the uptrend in some kind of at least the sideways scenario, possibly downtrend, whereas here you are in clear stage 2 confirmed uptrend, probably on the way further move up. As you have here the first base, only thing that you have here basically second base forming, starting new stage 2 uptrend.
And you're pretty much, for your trading style, which is a little bit more short term, you're pretty much fishing within a stage 2 uptrend. You're finding spots and bases and consolidations and breakouts within an existing stage 2 uptrend for the most part.
Exactly. For me to start buying, I would be looking for at least the, what I would say, early uptrend. It means the 200 days, then the 100-day moving average, 50-day facing up, and stacked above each other for at least a month. And of course, then it depends on the depth of the base and the overhead supply that we just talked about. But those are the points that we'll touch on in a further slides.
Great.
And yeah, let's now get actually to some real case scenario and how to handle this whole uptrend, or how I would handle it in my trading, in my style. I guess the first thing what you need to understand is when you're getting into a trend, where you are in the uptrend. As we talked about now, are you moving back from some prolonged correction, some stage 4 downtrend, from some sideways choppy action, or are you in the midst of the uptrend? And if so, where in that uptrend? Are you out of the base? Was there any natural reaction, meaning price drop without any further base, like the normal base you will expect, like 4, 5, 6, ideally 8 weeks, whatever is, I would say, below 5 weeks, 4 weeks, that what we can call natural reaction, not proper base. In my experience, what we can observe from the bases, usually would be looking somewhere 1, 2, 3 max for natural reaction before you want to expect further bases to be set up. And as you will see in the example here with the Palantir, it moved into that stage 2 uptrend, progressed further base 1, base 2, and further here it's kind of a tricky scenario. I would say there's the recent market correction. Really depending on, I wouldn't necessarily get stuck in a terminology whether it's a base number 4 in a stage 2 uptrend, or whether you would consider it as a base count reset, since we have a market correction of above 20%. To me, it's really just getting lost in a wording, and it's really your point of view. I don't find it that important, whatever you categorize it. Now the interesting part. How do I start getting into that position? And how I actually started getting into that position is, so first we would be looking into break of the downtrend itself. I'm not gonna be trying to fish the lows. What I want to see in the base would be at least the break of the horizontal line here. Clearly you can see what you deal with here is that base is kind of skewed. It's very time compressed. You have just only few days, few weeks to the left. It's very sharp base. So now if I decide to go into such a trade, then there are certain factors that I already have in mind when entering such a trade, and how I'm going to approach it from a risk perspective and from taking the profits. That's the important part that we're talking about, having the price progression in mind when you're entering from any buying point. What you can see here, what I try to sketch here, if you're buying in such a low area from kind of this pullback, or from Mark Minervini would call it low cheat, then you're immediately running into that resistance supply here into those levels. And as you will see here further, what I would be immediately thinking, okay, we have this first level, and then we have here this 100 level, the psychological 100 area, where probably there are going to be some sellers too. So if I'm going to get into this trade, I'm probably start reducing somewhere in that area, probably reducing, if it moves even further, reducing further. What I did here, started with a very tight stop, with a 2% stop only. It also allows me, if you have such a tight stops, you can try multiple times, because then if you get your 3, 4, 5 multiple risk ratios and next tries, then it's gonna all pay off. What I did here, started with a 2% stop and immediately reduced into that first, as you can see here, into that first supply area. This way, as we discussed before, about the free rolling concept. We started with a 2% stop. Now if I reduced, let's say, 30% or 40%, now I'm moving my total stop, if I get stopped out, to less than 2%. I might be talking now maybe 1.5%, 1.25%, and so on. What happened after? So naturally, very often it happens, it turned directly on that resistance. I got stopped out. As you can see, I further moved that stop a little bit more up. This total stop was 0.5%. Nothing very dramatic. I can just refocus and wait for another buy point to present itself, which it further did. If you look at the volume action, actually very nice volume action. You have a higher volume up. On the pullbacks, you have a decreasing volume, and it formed another very nice, this kind of another, you can call it a pullback buy, or again the low cheat with actually more defined pivot. When it crosses this high, I would be starting to buy again. Sometimes I will be trying to, which is maybe one of the drawbacks also in my trading style, I might try to front run the breakout sometimes. Also the reason there is to, again, minimize the stop. So I might be trying to get a little bit lower with the thing that, okay, there are increased odds I'll get stopped out, but at least that stop will be lower. This time that breakout actually worked pretty well. It immediately moved into those areas what I expected would start forming another pivot. As we can see here, I started reducing into these, onto that, as it crossed to that kind of area where I would expect another pivot, and it was approaching this 100 Livermore level. That's a term I picked up from Leif. As we know, Livermore psychological levels 100, 200, 500 Anaconda steel. And logically, again, started correcting there. Honestly, naturally, I would expect some. For me, that's why I move the stop up and place it into an area, since we would expect, if you have another pivot setting up, then you would be expecting some action, kind of staying inside and forming it, basically turning that prior resistance to support level. You want to kind of stay on this kind of a red box and form the pivot there and move further through this area up higher. Unfortunately, it didn't happen. It stopped me out again, but as you can see now, I reduced twice. Now I'm getting stopped for a break even. So now I'm probably looking for some gain of, I would say, I don't remember exactly, but I think it was somewhere like 5%, 10%. So the total might have been maybe around total 5% gain. Further action, then we're starting to look for a normal base. Unless there is again some similar setup presenting. Here we had a nice shakeout from another area. In my style, this would be very aggressive, but also probably buyable. Unfortunately, there's a little gap, so it's kind of a tricky where you're gonna place your stop. And finally, we set up that pivot that we expected here. Finally, we set it up here and you can see also that base is pretty symmetrical. So I'm kind of here. I sacrificed myself and bought the gap up right to 100 level. What I would do here is, it's kind of a counterintuitive thing, how to cut your volatility down, because a lot of people will say, okay, increase volatility, I'm just gonna increase my stop. Well, I would try it the other way around. Tighten your stop and try it multiple times. Right? At the end, like if you count your money that you lost or gained, then all the money lost on one stop may be, basically 3 tight stops might be the same thing. So why not try it, and maybe you'll get lucky second time and it will save some money. So if we go further, how to handle the trade, here we've kind of logical what happened here. We crossed the 100 level and finally the real buying power started showing up. Already not that many sellers left, so here you have a very nice leverage what to do with the name after. Now if you're getting into the area again here, resistance area, now you have a leverage, what we talked about with the free rolling. Now you can decide, depending on your style, are you gonna try to hold through another handle, since we're approaching area where it would be very natural to form the handle which you're finally getting? Are you gonna try to hold through it? Are you gonna try to reduce some and get back in? Or maybe if you're very short term, you can also book the whole gains and wait up for another people and try to be creative getting back in. And you have multiple ways how to reduce the risk, right? You can, if I'm looking for a breakout here, very often people reach out to me and they ask, like, okay, your average stop is 3%, so you automatically set your stop for 3%. It's actually not the way. What I do, I would start with a 5%, and actually if you reduce some into strength, let's say you start with 5%, you reduce something, and then you get stopped out for 5%, your total loss is not 5%, it might be, for example, 3%. Has similar thing with taking some profits, moving your stops, and as you move here, as I was saying, you have now a lot of options what to do. You can use your moving averages. You have here a 10-day moving average. You can place your stop there if you know the character of the name. Here, respecting the 10-day, moving along it, you can set it there. You have a break even. Or if you want to allow a little bit more undercuts and you're trying to hold a little bit more long term, maybe you can place it a little bit lower, peel some off, and again, there is the trade. You don't have to move the stop at all. You can start with your initial stop, even if it was somewhere here, and only reduce the position. But really the goal is, as I said on the second slide, to improve your worst case scenario. So if you're getting into the risk multiples, you don't want to be giving back all the gains. You want to protect those profits, so you can focus on another name setting up. And for me personally, what I would do here, as you can see here, reduced, I would expect here a natural handle. One thing that I'm a little bit bad in is trying, a lot of people wait for a close below the 10-day moving average. Or very often cut it intraday, as I did here during the shakeout here, move to the handle. As we set up the handle breakout, I would be buying here again. And what you will see on the next slide, if you get into certain scenarios like out of the base, little downside of it is that sometimes you might be trading a lot. You might be trading around the position, sometimes even forcing trades, but it all should be predetermined. You should not be really calling any audibles during the day and trying to get into some buy points that you didn't figure out before. And as I would say, what I did here, as you can see, I would be buying that handle again, as we discussed, reducing it a little bit into strength. Here I got stopped out prematurely, I would say, looking at it back from a post-analysis perspective. But again, we have here reduce, break even, stop. So I'm looking, at least I guaranteed some gains. I don't have to set, in case we go here to the further downside, I don't have to sit in the loss. I have guaranteed profit in the bank, and I can be focusing on the next price action. And as you can see here, further try to get back on those pullbacks of the moving averages. Similar scenario, reduce, got stopped out here. Finally, I was waiting for a classical breakout to new highs. The reduction here, I remember it was due to market was getting a little strange, so I just took some bit off. There's no further thinking behind it. Stopped out for break even, as you can see here, even though tiny gain, but still not a loss. So that's also the reason when several people reached out to me and they're saying, how is it possible that sometimes your batting average is getting so high? Well, that's the thing that you have to figure out what works for you in mathematical perspective. It doesn't really matter if your ratio is 4-1 and you have 30% batting average, or you're very aggressive or reducing the risk. You might be cutting down the ratio a little bit lower, but on the other hand, you're increasing the batting average to 50-60%. So the total number of the adjusted gain to loss ratio adjusted to batting average is approximately the same. It almost makes sense from a mathematical point of view. And I'm not gonna go completely throughout the slide. there is just a key principle that I wanted to highlight. As we discussed, there are multiple ways what you can do with once you start getting into profits, how you can manage it. Right? You can sell a portion for profit. We start here with original stop for 5%. So let's say you sell quarter for 3R. Your total result, if you get stopped out, is break even. And magic happens here. What I like to do here. This is the most common scenario which I would be doing in my trades, selling for portion for profit and moving stop up. Let's say here we reduce stop just from -5 to -2.5%, and suddenly even selling a quarter for 2R, you're already operating with a positive expectancy. So I think this is for me, this part here is for me the sweet spot. If I would be reducing this quickly, then I'm not gonna be usually selling half. I might be selling most often between quarter, 1/3, maybe up to 40%, trying to really guarantee that positive expectancy ASAP. And of course,
sorry.
Yeah.
Of course, I'll let you finish, please.
Yeah, of course, if the name moves a lot, let's say 10, 12, 15% up, we don't want to give back all the gains. So then, for me, the recommendation would be just sell something for profit, move it to break even, and here even the 1R guarantees you positive profits.
Yeah, what I was going to ask is, does it depend at all on the strength of the market and your recent trade feedback, which one you typically do, whether you sell 25%, 30% at 2R or 3R? How do you decide, per trade, what strategy you're going to go with?
Yeah, there are multiple factors. I have it in one of the last slides just to recap. Of course, there are multiple ways and multiple factors that come into place. Since trading is more art than a science, there are several factors like amount of overhead and the sharpness of overhead. Of course, if the overhead supply is 2 years back and it's 15% decline, then you're not dealing with much. You can be very comfortable. On the other hand, as we showed in Palantir, you have there 40% decline in few weeks, then you probably want to be much quicker. Then, as you said correctly, the market conditions. How has the market been performing? And I guess for me, the more important than the market itself are the groups and sectors of that name. Is that sector hot? Is that theme hot? Is there a chance that, are there maybe another true market leaders from that group and the name might follow? Has there been any true market leader that already bounced from certain similar pattern? Like we had few months back, there was a lot of double bottoms bases breaking out. Has there been such a scenario? So it's also looking at the context. And the third factor also comes with how speculative the name is. What is the trading volume? What is the market cap? Are you dealing with some tiny cap under 1 billion? Are you dealing with Tesla? Of course, if you more speculative and more volatile name, as I said before, you want to cut down the volatility by taking your profits quicker and moving your stops quicker.
That's great. Thanks.
And another stats, not to have enough of them, just to show you the magic, what you can do if you move a little bit of your batting average or a little bit of your average gain or average loss. As you can see here, there is a return over 100 trades. And look at that magic. For example, here you're moving, let's say your average gain is 6%, which is very much achievable. That's nothing too dramatic. And your initial average loss is 3.5%. Your batting average is just a little than 50. Over 100 trades, you have 27%. If you just move that stop a little bit tighter to 3%, it means you might be a little bit quicker on taking some profits, or a little bit, just tiny bit quicker in moving stops. First of all, your batting average might increase because, as we discussed before, by moving the stops, you are very likely putting yourself in scenario of potentially improving that batting average, and you improve your average loss. In that case, suddenly you're moving just with this tiny adjustment of 0.5% and 3% batting average. Suddenly you improve your return over 100 trades over above almost 20%. All right, and then if you're looking here, that if you are in some awesome conditions like maybe 2020 or also last year, when you're operating, when a lot of names are flying and you can be very quick on moving the stops higher. If you move it to, let's say, 2.5%, which is very tight, then you're getting, even with batting average below 50%, but guaranteeing this over 2 hour, basically over 2.5 hour, suddenly you're looking almost a super performance of nearly 100%. Yeah, maybe not to forget this very important highlight here, that especially in the bad times, you cannot really influence when you're getting into a trade, you cannot influence what's going to be on the upside so much. So you really have to take care of that downside. And again, it's come for the multiple times mentioned today, improving your worst case scenario and really taking care of this column right here. Before, when we were showing the Palantir, we were showing trading inside of a base. We showed starting at the bottom of a base, going through alternative buying points inside of a base to a traditional kind of a high handle scenario. But then, of course, comes the scenario once you get out of a base and you're in a strong uptrending market and you're a very quick trader. What do you do? Because you very quickly you might get yourself out of the position, and of course you don't want to sit there the whole uptrend, which can be lasting for a year, 2 years, just watching the name go higher. So again, it comes down to understanding how the name is acting. Of course, if you have time to investigate and look at it, it's always very good to know the character of the name, what the name was doing in the past, as I will show here on the example of GEV, which I traded multiple times last year. What we can see here, there was a first base, then we were looking at one natural reaction, second, basically here you can consider as one ascending natural reaction, so totally you have about 3 of them. What's another characteristic of the name? It's respecting the 10-day moving averages whole way, try to undercut it several times. I remember vividly there were also some bad news as they were focusing or shifting the focus from a wind energy to nuclear energy, but it always just shook down the 10-day moving average, continued higher. And finally, once we got the change of the character, when we started closing below the 10-day moving average, it finally set up that second base that we were all expecting. Unfortunately, then this mess happened here and we had to wait for another base. So it's very important to understand what you're dealing with, and also how is the name acting in extensions. What are the extensions? Are there any blow-offs? Are there any high volume reversals throughout the cycle, and so on and so forth. And so if we would look how I would trade the name or what I would do, so let's say I buy the breakout here in this area. As you saw on the slides before, you can probably guess that I would be probably trying to hold at least or majority of the name. If I peel here, I would peel probably 10-20%. As I said, when we're looking at the first base from the stage to uptrend, you want to ideally wait at least through this first natural reaction, especially if it's kind of a high handle scenario here when you haven't even advanced much through the base. And just basically checking out. If you look at this, it's kind of a pullback buy to the base itself. And then further, as we start advancing, you're starting getting this David Ryan MVP criteria, which is, of course, is a sign of immense strength, but it's also a sign that you should be ready for a pullback and you can expect some sideways action. So for myself, if I would be getting on here, I would be reducing largely here. I would definitely keep some small portion of the position, let's say 1/3 of the original position or something like that, to ride for the bigger trend. Because for me personally, if we start from the, let's say, new uptrend, what I will end up with throughout that uptrend, I will have kind of a basket of tiny positions which I reduce throughout the cycle, but I'm very bad in selling that last remaining portion. So I might be sitting with few larger positions if we are in the midst of the uptrend, and then pretty big basket of those tiny positions if I didn't get back on. Personally, I approach the each add-on as a new trade, so in my stats it kind of shows as a new trade with the new statistics. And as you're starting getting into from the base and you're seeing the natural reaction, of course you have to keep in mind that you cannot expect the new base right away unless you're looking at some slow mover. So you always have to keep in mind that the first few natural reactions are addable. So you can be easily looking into the add spots. As we said here, it's respecting the 10-day moving average. If it bounces here from a 10-day again, very easily addable, as you can see here in this breakout. Volume coming in, sign of strength, you can be buying, adding back, and so on and so forth.
And that natural reaction is really tight as well. Really holds really tight against that 10 EMA. Exactly as you said.
Ideally should be very tight. You don't want to have some very volatile action, but which is much more difficult to deal with. I'm not saying not possible to trade, but again, you're dealing with a lot of other factors that you have to take into consideration. Because at the end, in the stock market, anything is tradable, right? You can trade anything any time of a day. Nowadays, you can just with 2 clicks, you can enter a trade. So it's all right. And just touching a little bit also on the alternative buy points, as you could see probably also in that Palantir example from before. Personally, I would not be looking always for a breakout to new highs, as I said. Very often I will be front running the breakout, or looking at the natural support areas. As the example mentioned here, the pullback buy. When you're looking at a pullback buy, again, it comes down from knowing the character of the name. As we saw here, as we discussed thoroughly, respecting the 10-day moving average. So this is the scenario of the GEV from this year when I started trading it again. After that, as you can see, after it blew out here, set up new base, and now I know, okay, previous cycle, what did it do? It formed a normal cup. It kind of set up a high handle or first natural reaction right above the base with a pullback back to the base. So okay, I probably know what I'm dealing with, so let's try to get on. Especially given how powerful this thing was, there was not too much space to get on board. So from the pullback area, you always want pullback. You don't want to be just buying random mid-air price fluctuation. This is not a pullback. Pullback should be into some kind of logical area, and as you can see here, we have a kind of the resistance area, supply area here. We have new high breakout here. What the thing do? It crosses to that. You have here two logical support points. And you have the 10-day moving average, and you have that price volume area here, where it finds the support, bounces back from there. So I'm not necessarily increasing my risk exposure by waiting all the way to new highs, but I can very easily minimize my risk of seeing the volume coming in here, finding the support rate of the 10-day, and I will be kind of buying as it crosses this kind of upper wig of the day before, putting myself in a very favorable situation in terms of risk multiples. And then comes the same scenario, reduce here a little bit portion, riding probably at this point, I'm pretty confident to say that I was probably having a stop already at break even, since we have also 10-day moving average there. So it would be very logical area to find support. Unfortunately, what happened here is kind of changed the character, which is also one thing to mention and to notice. If you see from the name, okay, suddenly it's starting to respect, instead of 10-day, maybe 20-day. So maybe if we move up from here, and I'm somehow dealing with the name further down the uptrend, I might be probably thinking more moving the stops to 20-day instead of 10-day, since I know it's probably changed the character a little bit. But as you can see here, it ran what I would be thinking here. Okay, I try to reduce a little bit, then we have a 500 level. Again, psychological level 500, I'll be trying to reduce a little bit there. So naturally, hit that resistance 500, and the same scenario, somehow bounced to the moving average, found support, and I started buying in these pullbacks from, again, those 10-day moving averages. It was crossing those highs, a little front running, and same story again, small volume pullback buy, high volume follow throughs, reducing a little bit into strength, moving the stops, and moving on further. Of course, this style has some drawbacks, as I said multiple times. One of the drawbacks is that if you're too tight on the risk, what might happen, and I can guarantee you that it will happen, is you will be getting knocked out prematurely. As shown here in this example with KRMN, which I traded this year, as you can see, there is a lot going on. And I try to buy here from this very nice kind of IPO, kind of a skewed cup, as it formed this kind of a contractions in the price and volume, and broke out, reduced a little bit, again, as we said here, a little bit into those highs, to the resistance, reduced prior to earnings. Then we have a earnings report. My stop was below the 10-day moving average. If I would be having the style like some other traders do that wait for a close, I would be very much safe. Unfortunately, I'm a little bit of chicken when it comes out to the risk, so I chickened out here, hit the stop, then 10-day moving average completely shook me out, went without me. Now when this happens, how do you want to deal with it, right? So first of all, do your post analysis. What did you do wrong? How you can improve it further? Did you stick to the rules? It also doesn't mean that, okay, I found something, then I'm gonna completely change my rules and rework my playbook, but is there probably something I could have done better, right? And of course, another thing is if you identify as a true market leader potential, then you want to probably be getting on back. And the true market leaders, of course, as they always say, they're very hard to buy, very hard to get onto. Then the downside of this style is then you might have to be trying to investigate really some alternative buy points, try to get a little creative with how to get back onto the name. If it goes and has very shallow pullbacks, very short pullbacks, might be a little bit tricky to deal with the situation. For me personally, example what I did here, as it formed here, this kind of started forming this mini base with the IPOs. We can be thinking also a little bit extending the time range. You don't necessarily want to wait with IPOs 4 to 8 weeks for a base, but few weeks is okay. And as it kind of finally the volume here on those sell-offs really dried up, and we can see this higher volume coming in, pullback buys through this resistance, mini resistance area as it pushes through. So I'll be buying here. And unfortunately, second time, same scenario that happened here. Really didn't learn my lesson. Thinking, okay, hitting the resistance area, it should kind of respect the 10-day moving average. Again, move the stop very bit higher to break even, since I don't want to give back all the gains that I earned. Again, got stopped out, shook out, and without me. So getting into a name for a third time, same scenario, pullback buy through this mini resistance area, moving the stop, reducing, and trying to grind the name further. And another thing which will be happening to you most likely is if you're trading, especially in these alternative buy points like pullback buys and low cheat areas, and you're dealing with the overhead supply, you might be kind of forced to overtrade. You might be really doing a lot of trading around the position. So if you do that, of course, be mindful that you're not losing necessarily just the financial capital, but my mental capital is also very important. So what happened to me, for example, last year was the typical example. It was the APP, which I traded like three times, always got shaken out on the trying to trade imperfect buy points, and with finally set up the perfect buy point that really went. It went without me because I kind of lost conviction, lost that mental focus on the name. So just really know what you're dealing with, know the odds, know your numbers, how you're performing from the long-term perspective, and really do not try to take away your focus from the name. If we go further, just kind of we're coming to the end to summarize also what you already asked before. What are the factors that you have to consider when dealing with trading such names? Of course, you're looking at the leaders versus laggards. It's a very important thing. Of course, in a new market uptrend, leaders are called leaders for the reason, right? Leaders lead. So very often, if you will be dealing with the names which are breaking out later, when those leaders are extended and they're going through those natural reactions or second bases, and suddenly you have a names which are setting up only that first base, just be careful on the lookout whether the name may be laggard, what kind of group it is. It might be maybe some, I don't know, insurance name, things like that, some slow movers with lower relative strength compared to the other names. So be mindful of that. Identify the market conditions, as you pointed out, Richard, the good environment versus bad environment. It also important thing is to mention, market environment doesn't necessarily mean just Qs or SPYs going up. It really means, are the breakouts on your watch list following through? Is your whole portfolio, is your equity curve moving up? Or are you getting yourself the feedback that you're getting the volatility around buy points, you're getting the failed breakouts? Are you seeing some whipsaws in sectors? For example, you set up a watch list and you see, 20 semiconductor names, and you look at it at 2 names and suddenly you have a biotech setting up. So be mindful of that. And as we already discussed before, several factors to consider: trend, group sector behavior, the market caps. Are you dealing with some tiny caps? There is really like a large or a mega cap like Tesla, Google, and so on. Also look at the fundamentals. For myself, the fundamentals, they don't necessarily mean too much when I'm entering the name, but they're very important for me how I'm gonna deal with the name later on. If the names are there, if I see very promising fundamentals, if I see fund ownership increasing, that for me it means a conviction to hold the name longer. It doesn't necessarily mean I'm not gonna buy a name if the fundamentals are not there, but I'll be probably much quicker to scale out of it. And of course, the redeployment strategy, the mental capital, and adding back to the name. So even if you get out the name, still watch the name very closely, how it's acting, what it's doing, and if you have a chance, you might be thinking really about trying to get back on, especially if it's a true market leader and it's not too far in the cycle. If it's getting a little bit too far, if you're getting into base 3, 4, 5, and you're seeing some very volatile bases, then also be very mindful of how you're going to approach the trade. You probably then going into a scenario which is where you want to be probably even quicker and taking profits. You're probably not going to be getting so much upside anymore if you've been into uptrend for multiple years and you went through several bases without any larger correction. And to conclude the presentation, I didn't want to forget about my audience and some people that reached out with certain Q&As, which I didn't find any space where to put them into a presentation. So I just wanted to touch on those topics because I think it was very interesting questions that people ask. So I think there's a good chance to really go through them. So there was a couple of questions asking about holding through. How do you manage holding through pullbacks, or when do you decide to hold versus take profits? So you probably know by now, and if watching this presentation, that you have to expect some natural reactions. There are healthy price action, Yeah, and if you know what kind of a name and the character of the name you're dealing with, that kind of improves your conviction and your kind of knowledge what to do with it. And of course, at the end, it all comes down to numbers. So you really know your long-term or longer-term numbers, your average gain, average loss, betting average, and try to improve it over time. One interesting question was, what do you do during the ape season? I suppose that means when a lot of very speculative names are flying up, GameStop and so on, and you're really getting the FOMO of chasing everything. So, but defaulting back to your mathematical framework, really, I think that helps those kind of have that long-term convictions where you're gonna be in few years if you really stick to your principles and your scenarios. And if you know there's kind of discover that one of those names is not really moving the needle anywhere from the long-term perspective. It's only thing that it's doing probably if you're really trying to FOMO into a trade, that it's putting the higher odds of the wipeout and unnecessary gains, where I think one bad trade can really destroy the months of losses months of gains that you worked on. So be mindful of that. A lot of questions about mindset and how you keep calm and what do you do. Some recommendations if you are a 5-year-old. So again, having this kind of a set of rules and knowing the numbers takes a little bit away those emotions and reduce that emotional trading. So be aware of that, and know your action plan, know your game plan before every day. If you want, you can draw up, I don't know, if you want like a 5-year-old, you can draw up some characters with it and saying this is what I'll be doing and buying, or you can just highlight it with the markers or put it into some spreadsheet. But do not try to call audibles during the day. Have very rigid rules. And if you cannot really sleep during the night, that you think about your positions, that probably you're trading probably a little bit too large. So also be mindful of the position size and what's your, not necessarily the risk, but also what's your kind of a mental capital, what kind of size are you able to take on. And trust the process, never dictate the money to rule your trading. Always focus on the price action and what you're doing from the process perspective. I think taking away that focus and focusing on the money, and especially the short term and trying to get rich scheme, is a disaster to hell. As also I personally experienced during the USIC when I really reshifted that focus on those major gains, and kind of it was a disaster and way to hell. And then we have here the magnitude versus duration moves, meaning the magnitude playing the high tide flags, and duration moves how to deal with the IPOs, because then you're dealing with a little bit different scenarios than a normal traditional basis. So naturally for those high tide flags, you want to be accounting for a little bit higher risk reward ratio. So instead of depending again on your style, instead of taking, for example, first scales for 1.5, 2R, you might be thinking more about trying to hold at least for 3 to 4R for our ratios, and also mindful of the risk. Of course, if you have a sharp move up very quickly, you don't want to give back all the gains, but you have to find kind of this sweet spot how to play with it. And with the high tide flags, you can really expect very powerful moves very quickly. And IPOs, there I would say don't be afraid to hold through those natural reactions that we discussed. With the IPOs, you can be looking for a magnitude move of multiple months or even a year if you get lucky. Again, depending on your style, then you have to figure out how you're gonna be handling the name. If you're gonna be, for example, reducing a little bit and then riding, for example, even maybe 50-day moving average, if you want to be holding a little bit long term. So be mindful that the IPOs might not give you second base for some time, so you can be a little bit more patient with that. And with that, we reach the end. If you want to know a little bit more what I'm doing, feel free to look at my website, which I deployed a few months back, and I'm trying to put there almost all the trades what I'm doing, and I approach it as a interactive model book rather than any platform. So I want to have, instead of having printed out charts and having it in a book, having it kind of a software for it that you can browse through. And of course, when I'm doing it, then of course, why not for other people to see it? So you feel free to visit and click the donate button if you want. And of course, if you want to join some community of like-minded traders, feel free to join us with Leif or the Champion Team Trading. We'll be very, very happy to have you on board and share your ideas. And really, you can get a little more in depth into the style, into how to do it and what to do, and to really have a mentors alongside to help you with that.
Yeah, excellent. Leos, thank you so much for running through that. I've definitely got a few questions to go through. And first, I just want to add, can you go back one slide real quick? Just holding through pullbacks, you mentioned the pullback drawdown that you had last year. I think we did the interview previously this year where you talked through that, how you dealt with the mindset, dealing with that, the lessons learned. Definitely recommend watching that interview. You should be able to find it on the YouTube channel for everybody who hasn't seen it. But I think that was an excellent discussion and something every trader goes through. So I think that was really good. Going back to the start real quick, just from a high level, I'd be interested to hear, first of all, I think this doesn't get talked about enough, position management. I think everybody loves to talk about the perfect buy points, and that's the fun part, is analyzing charts, finding the pivots, all that. Position management is so important. Managing winners and treating them properly is what allows us to have a positive expectancy at the end of the day. How is your process for this, the one you presented today, how has that evolved over time, and what have been some key lessons along that way that made you implement, selling a bit, at 2R, and then holding the rest, moving your stop to break even? Were there any key turning points that you can look back at your trading career and say, all right, this taught me that, I need to do this, and that's how this kind of evolution has happened?
Yeah, absolutely. I think the biggest key lessons were when you get burnt, right? So when you over time that you figure out that it's really no point of trying to press the gas very quickly if you don't have the guaranteed profits. So I don't know if I came across that somewhere, or how I actually came up with that, but I keeping for myself, trying to keep these percentages and really having a visually display that whether I'm playing with the house money or whether I'm playing with my own money.
Right.
And it next to that is the having an idea, or really having it also somewhere displayed. What's your total expected drawdown, like your worst case scenario? So if you get stopped out nowadays from all the position, what's gonna be the damage? And of course, you're over time, and you wanna combine it and minimize it. So this is with the position management is the same thing, like that we talked about, moving those stops. So let's say hypothetically we would start with the allowable drawdown of 5% of your equity. Then this over time you realize that if you start improving your worst case scenario, suddenly you're dealing maybe, okay, my expected drawdown now is 3% because I reduced a little bit. And of course, you have to expect there will be choppy markets. So it happens to each of us that you will start ramping up, and suddenly you get knocked out and stop out everything, and you have to start over. But that's also one thing that not that many people realize. They think, okay, I always have to start slow, and start building out slow, and never stop pressing the gas. But that's a natural thing in trading, that you stop pressing the gas, and immediately when you stop pressing it, then you get stopped, and you have to start it all over again. So that's where this terms progressive exposure, I guess, comes, that you're somehow progressing and trying to push the gas a little bit more harder, and eventually it might happen that you have to step on a brake, that you hit some obstacle.
Yep. And then of course, you went through the different factors. I think it was the slide prior about that you consider with your position management. And you mentioned earlier as well, from a first stage base, you take less off, you're a little bit slower maybe to take off that first piece. Does that same kind of apply to where we are in the market cycle? Like directly after a significant correction, are you trying to let trades work a little bit longer before taking that first bit off? Or because of progressive exposure, you just want to make sure you get as good expectancy you can, so it doesn't really change where we are in the market cycle, your process for taking partials? I don't know if I asked that perfectly, but I think you know what I'm trying to say.
Yeah. It's, of course, the market cycle is very important. It's one of those things like that comes with this avoid the temptation during the late cycle. So, like if you're entering the correction and you went through some let's say very bad market, let's say not recently we had a 20% market correction, then you start identifying those leaders that you look at those various factors, like maybe they held 200-day moving average or they were the first one to recover. So if you kind of get this feeling that you're probably on a true market leader, then I think it applies even more that you want to probably reduce even less, or not even reduce, maybe really try to hold a little bit longer, because otherwise you might be really trying to getting yourself out of the one leader. I have the example this year which I kicked out myself. It was a decent gain, which last piece I sell for 50%, but nowadays the name is 150% up. So so just be mindful of that.
Yep.
But as I said, everybody always remembers those names that went to infinity without you. But then if the name corrects and it goes 50% down without you, you will forget very, very easily.
Yep, exactly. And then throughout the different examples you went through today, you mentioned changes in character a few times, like the stock had been respecting the 10 EMA and then broke it for the first time. Are there any other aspects of that concept of changing character that you think would be nice to share with people? And then also, how do you treat a stock that has a changing character differently versus one that's just been trending very calmly, evenly? Will you be less likely to add back on the next consolidation? Are you quicker to sell into strength if you feel like it's later in the trend, it's gotten whippier, changing its character that way? I think that'd be a cool concept to expand a little bit on.
Yeah, that's a very good point. The change of character, of course, we touched on changing character in terms of respecting moving averages. But as you're pointing out, there are many other multiple factors that you can be looking at. One of those are, for example, as we have here, the extensions. If you're having some extension climatic moves that you're starting to get multiple gap ups, like for example, as you can see clearly in this example here, we have a 1, 2nd, 3rd gap up. Probably the volume is not even running that much higher. That can provide you another context that something's changed, especially if you start looking also the average, the volatility it's trading on, and it starts trading very volatile. Then you might be thinking, okay, something's going on. For me, the volume clues are very important. If you see the names like it's highlighted here, you have low volume pullback, and suddenly you have a follow through and high volume, and suddenly you start getting maybe extensions into some even declining volume or flat volume. Then it's another change of character that you can be trying to look at. A little bit hidden thing is churning. It's kind of a tricky part. It's when you're starting to get a lot of fighting between bulls and bears. So it means you're getting a lot of volume, but especially if you see this somewhere at some extended highs that you see the price is not really moving, but you have a lot of volume, then it's probably a sign that there is an intense fight between bulls and bears, and you might be on the lookout for the reversal. And of course, then there are other things, like if you have the negative changes in character, like if you have a significant drawdown or highest volume ever, or similar things, or if it breaks some key support areas and high volumes, then you might be on the lookout to run for the hills.
Yeah, for more of a correction. Exactly. And then, of course, I've asked you this in previous interviews, but for folks who haven't seen that, and I know that it's not the focus of today's presentation, but it might be good context. what's your typical position sizing for these trades, and does it differ in a very fast mover, a high type flag magnitude type move versus one that you're looking for more of a longer term
Yeah.
trend?
Yeah. So my typical size is, or the ideal size that I want to get to is 25% of my equity. So it would mean if I'm 100% invested, then it would mean for positions of 25%. But again, it comes down with the market cycle. So if I would be starting very low in a base, that as you saw, for example, with that Palantir, then I will be starting maybe with a quarter positions, meaning, for example, 6 to 8% of equity, then increasing a little bit higher or potentially scaling into that full position. And then it depends on with the high tide flags, for example, it depends on the risk. You want to adjust the size based on the total risk. So if my average stop is maybe 3 to 5% to start with, if I see on a high tide flag it will be a little bit more volatile and I'm dealing maybe with the 9%, then I'm naturally gonna deal with that risk by decreasing the size. Instead of full position, I'd be taking maybe half position, things like that. And other
Yeah.
thing is, of course, the liquidity. If you go to smaller caps and so on, then also you want to be a little bit on the lookout on the size. You don't want to get caught too heavy in case of some major gap downs and things like that.
Yeah, excellent. And then I don't think I've actually asked you this before, but given your sports background, and sports can teach us a lot about learning to lose, learning to fail, and having to come back and dealing with that. Are there any key lessons that you take from sports that you think have really helped you when it comes to trading? Beyond just the competitive nature of both this being a game, a very very important game, but
Yeah, I,
yeah.
yeah, I think for me also because since both in football I played defense and in hockey I'm a goalie, so I was always the kind of a last line in defense. So I definitely learned that the responsibility. If I screw up, there's really nobody behind me to repair the action. So really be responsible for and be mindful of your own faults and what your mistakes can cause.
Yep. No, I
Uh,
was the same way actually. I always played defense, so the strikers up there in soccer can mess up and be flashy, but you have to be stick to a process and
exactly,
yeah,
because
be the last
there's
line.
there's nobody else behind you to save it anymore, right? So
Yep. Exactly. Awesome. Leos, this has been fantastic. Any closing words, summarizing, the key takeaways that you want people to have from this presentation?
uh, as always, I think the trading is the game of perseverance. So really stick with your process and trust the process and go back to your trades. If you don't have the stats now figured out or you don't know really what your average trading looks like, then really do your post analysis and try to kind of frame your style. You can always start with the foundations and inspirations and other master traders that I like myself that I found and try. You can start from that and kind of tweak it and find your own style, what fits you the most. And as always, never give up, really continue on grinding, study the charts, study how they behave, go through the manual, look at what's happening during the natural price cycle, and it will definitely help you because you will form that kind of a almost a photographic memory in your mind, and you will know what to expect in the next market cycle.
Excellent. And actually, I just remembered one last question I want to ask you. In a market more like 2021, where it's more pop and drop, the breakouts didn't really have the follow through that you talked about really looking for. Do you adjust this process at all? Selling a reverse partial a little bit earlier, moving your stop up to break even a little bit earlier. How does that kind of impact things?
Yeah, it's. I think that also the clearest example is, of course, 2021. But a lot of people, for example, have a in vivid memory this year when we started in not a very good note, and what I could see in January, still the breakouts were kind of working, even though there are some black swan events. But so until now, I was trading a little bit like the same, but further on, as the things stopped to work, I started trading a little bit quicker. So as I see, for example, what you will see, because it doesn't happen very often that we would just fall apart and really, have a major correction right from day one. So you will start seeing for us a lot of volatility around breakpoints, things not working very well. So what I saw in around March time, that I started doing much more trading, but much quicker trading, and it was still kind of working. But then eventually, when even that stopped working, then you really have to step on the brakes and take a little pause and reevaluate if really this is the right time to press in the market. And if not, just really wait, be patient for that prime conditions. They're gonna come back. It's frustrating,
Excellent.
but they're gonna appear.
Yeah, great. Well, Leos, thank you again for your time, for walking us through your process. Thank you, everybody, to you're watching. I hope you guys enjoyed it. If you did, go ahead and leave a like on the below. And we'll be right back with the next presenter. Stay tuned.
Thanks a lot.